MapMyIndia, also known as CE Infosystems, its IPO was one of the most successful in this financial year. It did well amid market volatility and worsening global macros. Since its listing in December, the stock price has rapidly surged to 1917 levels. In the last 1 month, however, it did fall 9% broadly in line with Nifty 50, and yet it remains above the issue price of 1,033 rupees. MapMyIndia's third quarter, if you look at it, it was a complete washout with revenue shrinking 23.5% and EBITDA dropping by 23% sequentially as well, impacted by subdued auto sales stemming from semiconductor shortage. Management said COVID-related pent-up demand led to a higher base in Q3 FY21 and Q2 FY22. Hence, growth in Q3 FY22 looked a tad weak. The company's EBITDA margin was flat sequentially at 35.9%, while PAT margin was 42.7%, in contrast with 45.6% in Q3 FY21 and 34.4% in Q2 FY22. Segment-wise, implied consumer tech and enterprise revenue fell 30.3% YOY, while automotive and mobility tech revenue grew 1.3% year-on-year. On a 9-month basis, C&E revenue was up 33.3% YOY and A&M revenue was up 39.6%. MapMyIndia has a large addressable market encompassing several industries including e-commerce, logistics and automobile among several others. The current Indian market for navigation, local intelligence and other services is still developing as the industry is in nascent stages and rapid progress has largely been witnessed by smartphone penetration in the last few years. However, high internet penetration and tech adoption in day-to-day life have been very rapid and therefore reflect a fast-growing ecosystem. MapMyIndia is one of the very few tech businesses that are profitable and simultaneously enjoys a solid moat in the form of regulation and expertise development over the years, which is hard to replicate. The company's operational cost structure is skewed towards fixed expenses and hence incremental rupee contributes to margin expansion. Since FY21, the company's margins have been above 30% and it should rise rapidly going forward. Additionally, the company generates a positive free cash flow that remains above 70% of the PAT over 2019 to 2021 with a robust book-to-bill ratio. In Feb 22, the Government of India issued a notification to prohibit drone imports to aid domestic production. Drone manufacturing in India is yet to pick up in a meaningful manner, but policy support has set the tone directionally. Earlier, drones only had military applications and now they're used in e-commerce, agriculture and even logistics. Therefore, their adoption is likely to only accelerate. Drones can be a consumer as well as a source of graphic information systems. Autonomous driving and advanced driver assistance systems is one of the most invested technologies. It has application in almost all automobile-dependent businesses and represents a sizable opportunity. Key enablers in ADAS mapping technology that needs to be precise and regularly updated and can be a significant revenue contributor to mapping and geospatial service providers. It is still early to ascertain the full potential of these technologies in India, yet it is safe to say that they are disproportionately in favor of MapMyIndia. We continue to see MapMyIndia's revenue growth in double digits with simultaneous margin expansion over the next 2-3 years. Arguably, there are several new-age tech companies available for investment in the market, but most of them are devoid of the combination of profitability, market share and regulation-driven mode, and that makes them risky bets. In a macro environment where high-growth tech businesses appear to be falling out of favor and investors are seeking safety in quality stocks, MapMyIndia is a square peg in a square hole. Its international peers are TomTom, Navinfo and Trimble, and none of them enjoy the same margins as MapMyIndia does. Justifiably, they do not trade at the same valuation multiple. We believe that the current share price does not fully reflect the growth potential of the company and the industry, which therefore means a good entry opportunity for new investors. Of course, a risk to watch out for would be market volatility due to macro and geopolitical events in the near term.